Hello, here we are, end of the week. We're back with our show to review the week that we had. The crypto market this week experienced a mix of volatility and stabilization, driven by macroeconomic data release, monetary policy expectations, and geopolitical factors. Let's look at what happened on the 10th. This week kicked off with optimism, with Bitcoin attempting to reclaim the $105,000 following a steady U.S. Federal Reserve interest rate, signaling a wait-and-see approach on monetary policy changes. Ethereum saw gains reaching $3,187. The Fed's decision to maintain the interest rate added stability market, with investors interpreting this as a cautious yet not restrictive stance, potentially beneficial for risk assets like cryptocurrency. The expectations around upcoming U.S. inflation data influenced market movements. Investors betting on continued moderation in inflation rates, supporting further crypto investments. No major geopolitical events directly impacted the crypto market on this day, but the general economic climate was positive. BTC showed bullish signs with the moving average crossing upwards and the RSI indicating there's still room before overbought territory. Ethereum's trading volume spiked, suggesting strong buying interest. Solana experienced significant growth, possibly due to continued interest in its ecosystem for decentralized finance and non-fungible token projects, indicated sector-specific resilience. On Tuesday, there was a slight retreat in the market as profit-taking occurred. Bitcoin traded at reflecting some profit booking from the previous gains. The market was still digesting the Fed's decision with no new policy announcements. The tech sector's performance, particularly the Nasdaq 100, dropped, influenced by the crypto markets showing the interconnectedness of tech and crypto investments. The geopolitical context was stable with no direct impact on crypto markets. Bitcoin found support at around $99,000, suggesting a consolidation phase. After initial gains, Ethereum faced resistance around 3,100. ADA Cardano saw a slight dip, possibly due to broader market caution, but its fundamentals in smart contracts and blockchain development kept investor interest. Rebounded to 222 after positive trade news eased the tensions between the US and major trading partners. Anticipation of more insights from Fed speech last week was what drove the monetary side. A temporary easing of US-China trade tension had a positive spillover effect on crypto markets. The trade news was the primary mover, with markets reacting positively. Bitcoin broke above the immediate resistance, indicating a potential for continued upward trajectory if sustained. Ethereum showed signs of breaking from its recent range with increased volume. Polkadot benefited from the market's positive reaction to trade news, highlighting its role in cross-chain solutions. On Thursday, the 13th, the market corrected slightly, with major altcoins like XRP dropping 3%, Ethereum slipping to 0.9%, reflecting a broader market adjustment. No new policy announcements from the monetary policy side were made, but the market was preparing for potential Fed's comments. Increased volatility, however, was observed, likely due to mixed signals from global markets and anticipation of the U.S. economic data. Bitcoin showed resilience, with support holding well, but with a cautionary note on overbought conditions. Ethereum's trading range narrowed. Chainlink remained relatively stable, possibly due to its utility in smart contract platforms, showing the strength of projects with clear use case in a volatile market. What happened on Friday? The week ended with a bearish note, with Bitcoin dipping below 94,000 US dollars amid rising bond yields and strong US jobs expectations, which traditionally signal potential rate hikes. The anticipation of Jerome Powell's testimony and inflation data released loomed over the markets. The bond yields and jobs reports suggested a stronger than expected US economy, which could lead to tighter monetary policy, negatively affecting risk assets. The focus was more on the macroeconomic data rather than geopolitical events. Bitcoin tested support levels, indicating possible further downside. Ethereum also faced downward pressure but was holding the key support levels. Showed significant volatility dropping within the general market, but also bouncing back faster than some memes, reflecting the speculative nature of the meme coins. The market movement was heavily influenced by US economic data and the Fed policy expectations. The week showed how sensitive crypto markets are to traditional economic signals. Technical indicators like the RSI MACD were critical in understanding short-term movement, especially with Bitcoin showing signs of overbought conditions. The anticipation of the US monetary policy decisions and inflation data was a recurring theme affecting market sentiments across the week. While direct geopolitical impacts were minimal, the broader economic environment, including trading relations and global market sentiments, played a significant role. There was news of the Bank of Montreal in Canada, which is important. The BMO has recently made a significant move into the cryptocurrency space by investing $100 million into Bitcoin exchange-traded funds, the ETFs. This investment was disclosed in a filing with the U.S. Securities and Exchange Commission. Here are the key points. The BMO allocated $139 million to BlackRock's iShares Bitcoin ETF, or IBIT. The remaining $11 million was spread across other providers, including ARK21 Share Bitcoin's ETF, Grayscale's Trust Bitcoin Trust, and Fidelity Wise Origin Bitcoin Fund. Approximately $17,000 was invested into ProShare Bitcoin ETF, which deals with futures. The investment represents a more than 1,000% increase in BMO's previous Bitcoin ETFs holding, stood at about $13 million. The move is seen as part of a broader trend of institutional adoption of Bitcoin through regulated investment vehicles like ETFs. The choice to invest heavily in BlackRock's ETFs aligns with current market trends, where IBIT is noted as a leading spot Bitcoin ETF with significant assets under its management. This strategic investment by BMO underscores a growing confidence in Bitcoin as an asset class among traditional financial institutions, which is good for adoption because this is what the crypto industry wanted. So we wanted the cryptocurrency to be adopted. And therefore, this adoption, which was the BlackRock ETF, followed by Grayscale and other institutional investors, very key. As a result, this is showing that crypto is now starting to get into the mainstream. When you have the Bank of Montreal being one of the players in the ETF space, it shows now the banks are really starting to adopt cryptocurrency. This is good for us in the crypto space because it's showing that the adoption is really taking place. Hearing that took place at Capitol Hill, where Chairman Powell gave the testimony, was important. It was more the stance that the Fed were talking about, how they don't take cue from politics, but they follow the economic data. Therefore, it was really important. But to us, what is important is the issue around quantitative easing or quantitative tightening. So let's talk about the current position of the US on quantitative easing. The recent stance is at the beginning of 2025, the Federal Reserve has been in a phase of quantitative tightening. This was signaled by the comments of the Federal Reserve Chair, Jerome Powell, who indicated in various statements that QE would only be considered when interest rates are at zero. This implies that the current economic climate, where the interest rates are not at zero, does not warrant QE. Instead, the Feds have been focused on reducing their balance sheet, which is a form of QT, quantitative tightening. That statement that was made by Jerome Powell had a huge impact in the market. Quantitative easing has a huge impact in driving the crypto bull market. Therefore, a lot of tokens, more especially if you look at the trends of tokens like Cardano, other tokens in the altcoin markets in crypto tend to go into a bull run when the Federal Reserve goes into quantitative easing. The news shared by Chairman Powell that the interest rate would have to go to zero before they would consider quantitative easing had a dampening effect on the market. However, the Feds, still following the outlined monetary policy, created some stability regarding the market being nervous about the effects of the new administration on the Federal Reserve, or the FMOC, which is the committee that makes decisions on monetary policy or the interest rates. For now, the interest rates are kept the way they are. The data is still being analyzed in terms of the economic survey data and indicators. The Feds are looking at PPI, jobs, unemployment, and all the data that provide an indication of whether to ease or tighten the interest rates. It is important to understand that at the moment, the Feds are focusing on their balance sheet, which means they are still in the quantitative tightening phase. The US economy has shown signs of robust growth and inflation that has been moderating. This has led to a policy of gradually unwinding the extensive monetary policy provided QE during the post-COVID-19 period. The Fed's balance sheet, which ballooned due to quantitative easing measures during the crisis, has been shrinking as part of quantitative tightening. However, there have been discussions suggesting that the balance sheet might need to reverse upwards to avoid economic downturn, hinting at the potential future of QE if economic conditions deteriorate. The monetary policy tool, while the Fed have indicated it would not hesitate to use QE if the economic outlook or crisis were to occur. However, the position is still that the interest rate would have to be at zero before the Feds would jump in and intervene. The of QE and the shift to QT have implications for the financial markets, particularly in terms of liquidity. So QE typically supports asset prices by lowering yields and increasing liquidity, whereas QT can lead to higher yields and less liquidity, affecting stock and bond markets. This has really been a challenge, and there's always been a debate around QE's effectiveness and its long-term implications, including concerns about inflation, asset bubbles, as well as wealth inequality. So the current QT policy can have criticism being labeled against it in terms of the impact that it might have in the market. But other than that, as I spoke this week about what drove the various bull markets in the crypto market, it's important now to understand this adoption of the crypto products or crypto assets into the mainstream economy. We are happy that BMO or the Bank of Montreal injecting investment. We're happy that the accumulation is still taking place between institutions such as BlackRock, Grayscale, as well as Michael Saylor's MicroStrategy. It's important to mention them because they really drive their accumulation in terms of buying more Bitcoin, especially when the market starts to consolidate. These good things are taking place in terms of sustaining the market cap of crypto as well as adoption. The other side is that the macroeconomic instruments and the immediate impact to traditional markets are now having a spillover into cryptocurrency. And now we're talking about the impact of QE. I need you to study more about quantitative easing and what it does to the price of your coin. I'll talk about it over the weekend, but it's important that you continue the research. Among the technical indicators, I mentioned 50-day, 200-day moving average, where they cross the MACD versus the signal position, the RSI. Those indicators will show you the expectation. But I spoke about the trading volume, right? So your trading volume is linked to the liquidity that comes into crypto. When there is more money getting into crypto, the more tokens are bought. My strong suggestion would be to remain with the assets that hold the most value. Certainly, my bet is on Bitcoin, Ethereum, Solana, Zoe, XRP. Those are the main assets that are focused on. I'm not holding any meme coin. I'm not saying you shouldn't. You can, but be mindful of the fact that we have a choppy market that is volatile. Therefore, tokens that don't hold that much value are often the ones that get exposed. You look at with the Trump token. Came in, consolidated, high market cap, and then 72%, boom, went down. Now it's doing some consolidation. You can take those high-risk tokens, but then understand the impact of the market registers far more significant to them than the assets that hold value. But then once you start to get to quantitative easing, you have to conduct a different analysis altogether to see which of the tokens are likely to be taken up when there is liquidity flowing into the market. Now, in this adoption, we know Bitcoin was the first to get an exchange-traded fund. Ethereum was the second to get an exchange-traded fund. There is an application for an exchange-traded fund for Solana and an application for an exchange-traded fund for XRP and an exchange-traded fund application for Cardano. What it means is if the institutional money flows into crypto, the safer flow for the institutions at the moment is via the ETFs. President Trump is talking about the strategic reserves of Bitcoin from the US. So do expect some accumulation by the United States. We know that other countries other than the US are starting to go in on buying and keeping some reserves of Bitcoin. Certainly when Bitcoin is at a premium, what is the next likely token to follow? My instinct is telling me Ethereum because Bitcoin is up 50% dominance of the market, and then you've got Ethereum at 10%. So the expectation is that the institutions will go to these assets of safety or the exposure that is within the instruments that they consider safe, which is the ETFs that are bought by them through the other fund managers. Do your own analysis on when liquidity goes up, where is it likely to be? If you look at institutional investment, that's where things are likely to be. Ordinary investors in crypto who are looking at really making good returns are spending time looking at the narratives that are going to take off. Institutional investors traditionally come in with a risk-averse approach. But in crypto, a lot of investors have made money because of risk-taking. Therefore, you've got two swings of the pendulum. It's going to be the asset or the funds flow to the safer tokens, and there's going to be fund flows to the riskier tokens, however, with higher returns. You will still have the ones and twos that are playing in the meme coins, and you will still have the meme coins that are going to shoot up and go down just as quick as they have shot up at some point. So I'm not saying don't look at the meme coins, but I'm just saying the meme coins are a total different set of risks altogether. If we talk about the high risk category in crypto, meme coins are the accelerated high risk, or they are high risk on roids. But if you are going to build a watch list, then be sure how you are going to look at that watch list. How is liquidity going to come in? Because liquidity is going to come in on low risk assets in crypto and then flow into the high return assets. The high returns assets in crypto will be the higher risk assets. So if the flow goes, you need to know which tranches of where you would want to invest. But for now, I would suggest that you keep your bet on the lower risk category, because otherwise, as the market is going up and down, unfortunately, there are flashes that are taking place, and there are a lot of leverages that are being flashed out of the market, and a lot of traders that are losing money. And hence, I still remain suggesting that trade spot, not leverage. This is not a leverage market trade. Certainly, I'm not trading leverage. I'm trading spot at the moment. You do need to have the stability within the global economy, and definitely the new administration in the US, you need them to get to that stability where they have negotiated these trade agreements they are negotiating. We are out of that paradigm that every week President Trump has an executive order about tariffs. Now we know the US is putting 25% tariffs on steel and aluminum coming from any other country. It's important to understand that there is going to be an impact. It's a tax. You are taxing the imported product into your country, which means your imported product at the sales point is more expensive than when it came to your country. These things have an inflationary impact, and because they become more expensive, sometimes it might create a disincentive for local buyers to buy the alternative. Maybe the domestic product, provided the domestic have the best utility. But then, like I had said in previous shows, this has an impact of altering the global supply patterns, because the exporting country that is sending the product to your country, which lands in your country, has the tax or the tariff hitting it, then those countries will take the products and find another market to sell them, because the purchasers on the other side are unable to buy this imported product because it's expensive. But to the exporter, volumes become a problem, because now the high tax that decentralize the consumption mean you have an abundance of the quantity, and therefore you have to find another market. So that's how the global supply gets altered. And also I've indicated the impact on inflation. So these announcements of tariffs strike the markets like a lightning rod. Imagine what happens to the steel producing company. The value of the stock of the steel producing company has to be revised. Their earnings have to be refocused, and therefore the earnings affect the investors that are investing in those stocks. But then what happens to the producers that produce the commodity? The commodity market also gets affected, because now there's an oversupply of a commodity. The demand pattern has shifted because of the tariff. So you've got this chain of events that affects the market when tariffs are placed on products. And it affects us in crypto, as we may not be trading in commodities, stocks, bonds, and yields, but we get affected as crypto participants, as well as all the other general market participants in financial trading markets. So it's important to understand that when the quantitative easing starts to come through, where would the first pot of flows likely be from institutional investors? Where would it be from those looking for high returns? Do your analysis now, but take what you in your bag and make sure it's in a resilient portfolio with crypto tokens that hold value rather than high-level ones. I wish you profitable trades. I hope these suggestions make sense to you and therefore draw a picture that is in line with your trading strategy. I gave a background to a trading strategy with examples this week. I hope that this has helped our traders. Market is in consolidation, and this is an opportunity for accumulation, provided you know the point at where you would accumulate. I gave examples of the technical analysis so you have an idea. Bye for now. I will definitely during the weekend be posting. I wish you all the best. Bye.